Welcome back to the Contrarian, everybody. It's my pleasure to be able to introduce David Hunter for the third time. He is the Contrarian macro strategist with Contrarian Macro Advisors. He has 50 years of experience under his belt, both on the sell side and buy side of investing. He's very active on Twitter. He'll respond to most questions on Twitter. He also puts out a quarterly letter. David Hunter, thank you so much for coming back on today.
Yeah, thank you for having me, Logan. It's great to be back.
Well, great. I think a good place to get started here is just maybe your assessment of where the market is right now. I know the semiconductors have really heated up in the last few weeks. S&P and NASDAQ have kind of played along with that as well. So my hunch is that you're going to say we're probably entering into your melt-up phase. But what do you think we could expect for the coming few months here in 2023?
Sure. Yeah, I don't think we're quite at the melt-up phase. My guess is we're probably not going to see the true melt-up phase until we get to new highs. But I think we've got a pretty good rally ahead of us. As you know, we're probably I'm look back to see exactly, but we're 4,300 is kind of a resistance area that I think if we break through there, it's going to kind of pull many of the bears over to the other side. Up until now, people are still, I think, by and large, the majority are still considering this a bear market rally, and they see the valuations and they see the Fed still not saying they're going to stop tightening. They're talking about a pause of some sort, skip. But for all those reasons, I think, and others, people still are cautious. But you are seeing, which is typical as the market moves up, as you get more market momentum, you start breaking above some of the resistance areas, more people moving over to a more bullish position. And mostly, I think what you're seeing is discomfort on the part of those that are short the market and those that are very defensively positioned, particularly institutions, as they see that their numbers are lagging. They can fight it for a while, but at some point they can't. And I think that's what the next phase is once we get above 4,300 in some sort of a meaningful way. I think you could have a quick run to say 4,600, 4,650, which would be about 10% from here. And they're not quite 10%, I guess, now. And I think that could happen this month, certainly. After that, I'm torn as to whether we're gonna, I think it could go either way. Either get a pullback of some sort that's meaningful, maybe even 10% pullback before you go again, or you could push right through, and this would be the melt-up phase. So if you get the pullback, it just kind of puts off the melt-up for another month or a little longer. But I think we're getting close. And the melt-up, as you know, I consider the melt-up to be the parabolic phase, where it really truly kicks in, and you don't get many pullbacks. You get very short pullbacks, but not much. I think once we get above 4,800 on the S&P, you could go 4,800, 6,000 or 7,000 in a matter of a month or two. Sounds crazy, but that's what I think the last blow-off move will be. My guess is we're going to see a lot of that this summer. Again, kind of depends on what that move is from, say, 4,650. Is it you get a few day pause and then you run, or is it something that lasts for several weeks? That just stretches things out. So, but either way, I suspect we'll be very well into that melt up this summer, if not completed by late summer. So, if in that kind of a scenario, with me calling for 6,000 to 7,000 as a top, you're in for some real fireworks if I'm right.
Absolutely. It would be a tremendously large rally to get, from where we currently are, from, even the all-time high on the S&P up to 6,000 would be an immense rally. I wonder, do you think investing is does psychology almost better explain these types of cycles rather than fundamentals or technicals? Because I know George Soros, with his boom bust assessment, maybe more plays along that line as well of, saying that markets way overshoot to the upside and way undershoot to the downside. Whereas, fundamentals would not suggest that the S&P should be valued at, 7,000. Do you think psychology almost plays into that? Is it a fear of missing out? Is it a short covering?
Yeah, I think all of those things. Certainly, every cycle, when you get into the end of the cycle, you get a lot of psychology in there, and psychology plays on both the upside and downside. So, as you approach a bottom, people get extremely bearish, and so and they start talking about much lower levels. As you move up, people are driven by, as I say, driven by the tape. They're driven by the momentum. So either momentum downward or momentum upward. So certainly there's been so much bearishness over the course of last year that as the tape moves up, as the momentum kicks in, it does force people to shift from a bearish to a more bullish position. Things may not have changed as much as the market looks like, it warrants, and yet that tape can certainly change people's way of thinking. So it's kind of that half glass half full, half empty type of analogy. Um, and so I don't know what percentage you want to attribute to this last rally, but certainly psychology is going to be playing a big role. And as I've said for a while, this is, I believe, is the top of a 41-year secular bull market. So with a bull market that started back in August of 1982, if this is the culmination of that, think of that. That's 4 decades worth of cycles. You've not just had one economic cycle. You've had several. You had in there and you came from 15 or 20% interest rates and inflation down to zero in 2020, and then back up here. So, there's a lot of things that have played in that 41 years. And if this truly is kind of the blow off of that, certainly it's going to include psychology. But I can say that what I think is hard for people is they think, and certainly a lot of retail investors and some institutions, they tend to look at the market and judge it on the basis of today's earnings or today's fundamentals or today's data, today's economic news. Markets are forward-looking and forward-looking to the tune of 6 to 9 months. If things start looking like the tightening cycle is over, that the pause is not only a pause, but probably the end of the tightening, it will allow investors, and particularly institutional investors, to look over the trough and say, what does the recovery cycle look like? And it's not today's earnings, and it's not today's fundamentals. It will be the anticipation that we're going to be in a whole new upcycle in the economy and in earnings beginning next year. And that's what you'll be seeing the market pricing off of. Rightly or wrongly, doesn't mean they're going to be right, but the investors are going to be looking over the trough. And of course, that will be the rationale to justify the prices. It will be the emotions and things that help drive it. It will be psychology and the momentum of the market that will drive it. So sure, you're going to have FOMO without a doubt, and you're going to have short covering without a doubt, and a lot of repositioning as people say, I can't stay defensive anymore. It's hurt. I'm going to lose my job if I'm talking about institutional investors, but if I allow my portfolios to underperform to this kind of magnitude, I'm going to be in trouble. I have to get on board. So those kind of things play into an upcycle. And because I think this is the last hurrah, the last move in a 41-year bull market, it's going to be steep. That's the nature of it. Is if you go back and look, the cycle, the what I call the up legs, get steeper along, and this will be the final one. So we had a very steep, what I would call a melt up in 2020, 2021. And this one will be an even steeper melt up. People think that the melt up I started talking about probably in 2019 or somewhere around there we're still waiting for it. I said, no, you had a melt up in 2020 and 2021. The market more than doubled in 21 months. That's a big move. That's what I'd call a melt up. But that doesn't mean we can't have an even steeper move here. And that's what I think we're going to have. So all the negativity last year and the sell off from 4,800 down to 3,500 was a bear market and allowed for a new leg to get started last October. We're in the midst of that new up leg. It starts kind of gradually and slow, and it builds momentum as it goes. So I think we're almost to that acceleration point.
Okay, you mentioned investors looking over the trough, anticipating 6, 9 months out. Are they looking past some serious issues, in your opinion, like, the banking issues we've seen in the last few months, just the extent to which Fed tightening has hit real estate, hit consumer spending? So are they looking over some more fundamental issues that in your mind kind of plays into your bust scenario?
Yeah, yeah. Like I said, that's the rationale that I think will accompany the bull. This last run. My own forecast is for a global bust, which I define as possibly the worst global financial crisis in history, certainly one of the worst, um, and potentially the worst global downturn, economic downturn in the post World War II era. That's what I think is coming in the next year. So, do I think the market will deserve to be where it's going to go here on the upside? No. I mean, I think I think in the end, it's going to go up and then it's going to go down and go down big. So, but I don't know that. That's my forecast. And there's going to be a lot of people disagreeing with me if I'm right about what's coming this summer. People are going to feel like the Fed is done tightening and that the dollar's selling off, interest rates are coming down, and there's reason, and the economy is not tanking yet. There's reason to believe that we can have a soft landing with inflation already defeated or at least coming down dramatically. Um, and I'm not talking about right here, but that's what I'm anticipating this summer. Is that inflation numbers need to be better? The economy is going to be holding up to some extent because you're going to have rates coming down, which will help housing and autos, and probably some retail spending. So we're not about to go into that bust yet. And so I think you're going to have a period of time for several months where it can kind of feel like you got the best of all worlds, or at least pretty good things on both sides. And as a result, people will think my bust scenario is gone. What are you worried about a bust for? Things look better. As you know now, people think my melt up, or up until now, people think my melt up is crazy, and they all believe the bust. So it's just again, I'm looking out further, and that's what I do. I'm a big picture macro person who's been through many cycles. So I'm not necessarily telling you I'm right, but it's certainly what I see, and I'm a contrarian, and I expect most people to think I'm wrong at during these periods.
Yeah, like you mentioned, the majority of people right now are anticipating a, lower market, definitely not a melt up. That's where you tend to get most criticism right now, is for your melt up call. I'm curious, what are factors that you would say would cause you to maybe change or, abandon your melt up thesis? Is there anything the Fed could do that would change that at this point, or if they were to further, hike rates or tighten?
Sure. If we got all of a sudden got runaway inflation, it turned around and all of a sudden it's going up fast like it was second half of last year, mid-year last year, and the Fed started talking much more aggressively on the hawkish side, it certainly could sideline this scenario. I don't think that's what we're going to get. And I'm not talking about, look at the game they're playing right now. They're likely in the June meeting going to pause, but they're not going to call it a pause. They're going to call it a skip because they don't want the markets to get ahead of themselves and think, okay, Fed tightening is over. So they think skip gives them more room. It gives them the ability to say, all we're doing is skipping a rate increase this month, but we'll probably come back to it. We expect we'll probably come back to it unless the data really changes our mind. So, they're getting into semantics here, partly because I think they still have hanging over their head this way that they don't want to be the Fed put. They think that game is over. They don't want to be encouraging the market to say, oh, Fed tightening is over. The Fed's got our back. Let's go. They're trying to say the Fed does not have your back. We're not done tightening. We have to give this time to make sure we're on the right side of this. So that's why they're playing the game between skip and pause, because it's the same thing at this point. And it's just, I think it shows they still believe they may have to tighten down the road, a month or two or three. But understand, I think in that semantics is also Bill Dudley's thesis that that the Fed should be watching the market and holding it back. In other words, if you allow the market to run, you're going to see inflation break out again. And so I think this is not what the Fed has done in the past, but the Fed is almost still thinking that their job is not just to watch the economy, it's also to watch the stock market, or to manage their policy by stock market. So they're not doing to the degree they were 6 months ago, which was I was very critical of. But I think it's still in the back of their minds that, gee, we don't want not just that they are targeting the market, but they don't want. They're really trying to put to bed the idea that the Fed is somehow a backer of the market. That's the Fed put. They want that dead and gone. It's not. I mean, they will have to come back if I'm right about a global bust, but it's not about the market. It's about the economy.
Okay. Does them tightening again play into the global bust at all? Do they step in again when they see the S&P at 6,000 and say, okay, we really have to tighten again because of this? Does that play into your bust at all?
Let's put it this way: it's not so much how I'm deriving my forecast, but I would not be surprised if it does. In other words, I can just imagine Jay Powell and his fellow Fed FOMC members looking at the stock market at 6,000. I can't imagine them coming to any other conclusion than, what have we done? We need to tighten more again. We shouldn't have taken our foot off the brake. I may be wrong. I mean, maybe they won't react that way, but I think the likelihood is that they do, because they are paying attention to the market, that they'll look. And don't forget, the market's probably going to have some company there of an economy that's not so bad. It's not in the dumps. If I can't believe we're going to be at 6,000 or 7,000 with the economy, heading straight down. So there'll probably be at least, still economic growth, or not anything that looks dire. So they're going to look at the market and say, I think if we allow this to keep going, it's only going to bring inflation roaring back. So I think the likelihood is that this pause is a pause that doesn't last more than a few months, and maybe less, and that you will see higher, them hiking rates again. So, that doesn't mean long rates go to new highs in this cycle, but it does mean short rates might go to new highs. And certainly it does mean that, you might see them, further QT or get more aggressive with QT or what have you. And I think those will all be the very wrong things, because I think, again, we've talked about the long and unpredictable lags the policy, and I haven't changed my mind that they've already over tightened. So if they've over tightened, and yet it just takes time to see what the damage done, they could be starting to hike and tighten some more right on the eve of real trouble. So they don't have an easy job. I certainly understand where they're coming from. Um, again, I've followed the Fed for 50 years. I know what these leads and lags are like, and I just think this Fed, more than any, is really focused on the present. I don't think they're all that forward looking.
Yeah, you mentioned that
Most
before of the Fed being reactive, not proactive, and that's because they're mainly looking at unemployment and inflation. What factors do you think would be better for them to pay attention to? Are there variables or, data that comes out that's more of a leading indicator?
Sure. Yeah, most of the data that they look at, not just inflation and jobs, but obviously by its very definition, if you see data, it's data based on last month or 2 months ago, right? It's not forward. It's not telling anything about they're extrapolating. They're saying, okay, the data is here. We can extrapolate from here. But yeah, there's certainly leading indicators. There's you look at things like savings rate plummeting, from where obviously it was elevated to unnatural highs during the pandemic, but it's come down rapidly. You look at credit card balances that are starting to ramp up at a time when consumer spending's been slowing. That's a sign that people are having trouble financially and need to use their credit cards to keep things going. Those are signs. You look at interest rates, you look at currencies, etc. Those are all things, and probably the reason I've been so critical of them focusing on the stock market is the stock market is probably your best leading indicator. Not always right, but by deciding where best it should go, and I'm really talking about what they were doing 6 months ago, not so much now, but they were when the market was down at below 4,000. They were deciding that they couldn't finish until it was down to 3,000, right, or maybe lower. I mean, they decided they knew best where the market deserved to be, or where they should help the market go. And to manage policy by that, you took away your biggest leading indicator. Markets are, like I said, they're forward looking 6 or 9 months. The Fed's not forward looking 6 or 9 months. And you do have to balance that with the fact that the market can get things wrong. So you go up and you go down. But lots of times the market does see things ahead of time. At 3,500, where were most investors? At 3,500 last October, most investors were calling for 3,200, 3,000, maybe even lower, right? The vast majority were saying we're just beginning a big move down, or there's a lot more to go. And what was it? It was the bottom, and we've heard all the way up to 4,300 how this thing can't last. It has to roll over, it has to go lower, and only now are we beginning to see people capitulate. So that's whatever it is, 7 or 8 months where investors didn't see what was coming, the market did, right? The Fed didn't see what was coming, the market did. So that is, I just think they've made a big mistake in turning one of their leading indicators into something that they need to target.
Yeah, targeting the stock market. And I know that housing as well might have also played in with something that they were targeting, just with how much that heated up in 2021. This is a big question, and I've heard you talk a little bit on real estate in the housing market, but what do you see or how well do you see that performing in the coming years? Because you have the melt up, I'm guessing real estate might play along a little in that. The bust, obviously, it's going to be hurt some, but then you have your post bust. type of, high levels of inflation. How do you see real estate playing out through all of that?
Yeah, I think we've likely seen the peak in housing for not only this cycle, but for quite a long time to come, meaning the balance of this decade and probably the next decade too, or certainly many years into the future. Um, and the reason I say that is because interest rates do play a big role, obviously, in housing, because most of us have to finance a house. We don't buy it with cash. So financing a house depends on a mortgage rate. Mortgage rates got down to what, probably 2.5 at their lows in 2020, and they're now up over 7. So that's a whole different um, pricing. You can take the same house at $500,000 at 2.5%, and now almost triple that on a mortgage rate. Your mortgage payment's through the roof. So it's an affordability issue. You can't. There's the games that get played, and you get subsidized rates for a little while if you want to play the risky game of predicting rates, or there's lots of things you can do to kind of um, soften that blow, but it's a big blow no matter what if rates are that big a change. So I do think this summer, if I'm right, I'm calling for the 10-year to drop to 2.5 this summer, or by the end of the summer anyway, if not sooner. Um, that would probably take mortgage rates back down a decent amount. Let's say um, if you can move the 10-year from what is it now, 370 down to 250, 120 basis points. You could probably take the mortgage rate down that much. So you get back down under 6, and you're going to have some people saying, "Well, let's run in there before it goes to 8." Right? We couldn't afford it at 7, but we can squeeze, and we can maybe buy a house at 6% or 5.75. So you're going to see people. I think you'll see some bounce in housing as a result of that, and you're seeing some of that. You're getting the spring buying, and you're seeing the reason you're seeing new home sales do so well is because the builders are subsidizing rates. They're saying, okay, we'll take a little bit out of our profit because we get more volume if we do that. So they're able to get a better mortgage rate there. And if they buy a secondary house, it's got to go to the bank and get a mortgage. So mortgage rate plays a big role. My view, obviously, going out longer term, is that in the next cycle we're going to have a big inflation cycle, and I think rates, not that they're going to be there anytime soon, but by the second half of this decade sometime, I think we're going to see double-digit mortgage rates, and probably high double digits, meaning 12, 14, 16%. Imagine, again, the guy that could afford a house at 2.5% I don't think he can afford that same house or even anything close to that at double digits, and at high double digits he certainly can't. So that's going to eliminate an awful lot of buyers, right? And at the same time, you're going to have more of the baby boomers selling. There is going to be more supply there, and a factor that I'm not an expert in the housing by any means, but a factor that can play a role, I think, over this balance of this decade that isn't talked about because everybody thinks you're going to be in constrained supply for a long time. You've got an awful lot of second home and now Airbnb type home purchases have taken place. And if the economy does what I think it's going to do over the balance of this decade, first the bust and then high inflation, I think it's going to force a lot of those people to say, "Hey, what are we hanging on to this house for?" They may not say that on their residence. They may say, "Well, we need a house. We're staying here." But when you have extra homes, whether it be for investment or whether it be for vacation, um, the dynamics are going to be such that I don't think there's going to be a lot of incentive to hold on to those. So all of a sudden, you got a big supply that nobody thought was there. There's a lot. it's amazing. And of course, in the global bust, there's going to be a lot of forced selling, even of residences, even of first homes. People don't realize how that can change in a hurry. If you go from a time when the economy is okay, you all have jobs, yeah, you know what your mortgage is, it's part of your budget. But if you lose your job or if things get tough, and I think stock market wealth is going to go down a lot, in the bear market, all of a sudden, um, you're going to see a lot of people forced out of their homes, whether it be through foreclosure or anticipating foreclosure. But I do think that means, as hard as it is to see it now, because the supply is tight and prices are still elevated, I think you are going to see a pretty good hit to prices during the bust. I don't know whether that means a 30% hit off the peak or what, but I don't think it's 10%.
Okay. Yeah, real estate is it's definitely been a well performing over the last, 40 years or so as rates have trended down from where they were. So that, yeah, it definitely would affect it in a big way to see mortgage rates go anywhere close back to where they were in the 80s. Um, but yeah, I was wondering, like, with de-dollarization, that's been another big topic recently. Do you see that as, or how much of a threat do you see de-dollarization as? Because you see some economies, China, Russia, moving away from the dollar more, but does that really take away significant demand for dollars and treasuries, or is that kind of not as much of an issue as some people are making it out to be?
I certainly don't think it's an issue in the next few years. I think people want to fast forward that and say, we're going to lose reserve status in a hurry. The Austrian school, a lot of the Austrians are out there because they hate what we've done, obviously for good reason. Want to talk about it, but it's going to play out over time. I do think it's a risk. Certainly over the course of a decade, not this decade, but a decade from now, we could have seen that happen. I don't think it's the next 5 years. We are losing. There's no question we're losing some of our trade in dollars. And what China did with Saudis, the oil side, it's going to get more. So I don't want to say it's not a factor at all, but I think there's nothing to replace the dollar as a reserve currency anytime soon. So as a result, I don't think it impacts the investment landscape in the next 5 years, 3 to 5 years. There are a lot of other factors I think that are bigger that will affect it. But the dollar, I'm of the belief that the dollar's not because of the loss of reserve status, although that may be one of the worries that helps drive it. My view is that the dollar, came down from 115. DXY came down from 115 in 2022 to 101, and has now bounced back, a few points. I think we're not going to go a lot higher here, and I expect the rollover take us down to the mid 90s first, and then ultimately down to 80. And I think most of that, if not all of it, happens before the bust, or a lot of it does. So that's a pretty big decline to happen between now and, let's say, the end of the year. But I think that's possible, and certainly a good part of that move is possible in that time frame. That that will be a big story, but it's not because we're losing reserve status. And I do believe in the global bust, the dollar will still be the place people run for safety. It still will be that safety trade. So if I'm right, I could be way off because pretty exaggerated call. But I've been saying the dollar can fall to 80 pre-bust and then go to 120 or higher in the bust, all in the course of a couple of years. That's a huge volatility, but it has happened and can happen. If you go back to some of the previous cycles, the dollar's had some big moves in both directions. So, um, at least that's my look right now. That's what my expectation. But in terms of it being reserves, currency status driven, that's not why my forecast is there. It's more the global bust, story of the Fed's what central banks are doing now, and ultimately what the global bust will cause.
Yeah, that would be a very dramatic move to see on the dollar index. Is that why your, for example, precious metals forecast is, pretty high from here as well in the melt up phase? Is because, you see the dollar going down, you also get maybe more of a risk on type of investor mentality. Does that play in with
Yeah,
your
it's very
precious metals?
certainly the dollar plays a big role. If I'm right about where the metals are going, it's not going to happen if the dollar stays where it is. So, yeah, weaker dollar plays a role. Lower interest rates play a role. Um, I think the whole uncertainty plays a role, and technically, I mean, charts really are the best charts I see anywhere out there in terms of a bullish picture. And that's hard for people to believe because they're flat on their backs and have been out of favor for a long time. But I do see some real potential there, and not slow potential. It looks like once they get going, they're going to really get going. So it won't be a straight line up, but there's some big moves coming, I think. Um, and we'll see what crypto does, but crypto's in the last couple of years been certainly an alternative if people didn't want to do precious metals. But I'm not sure crypto is going to be, or Bitcoin is going to be what it has been. Maybe I'm as I say all the time, I don't follow crypto, I don't follow Bitcoin, so I'm not, my opinion's not worth a lot. But I'm not sure we're going to, there's still a lot of bullishness out there, and people thinking that it's going to go right with the market in this melt up. People in the crypto space thinking that there's a big move here coming, and I may be true, but I'm not so sure it's.
For the post-bust recovery that you see coming after, the bust of probably next year, you see precious metals, industrial metals, oil definitely doing well, but maybe not as much the stock market, technology stocks, healthcare stocks.
Yes, yeah. If we want to talk about what happens post bust, be 2025 and on probably. Um, I do think you're going to have a huge commodity cycle. Maybe the biggest ever, probably the biggest ever. And I see oil going to $400 or $500 a barrel. I see copper going through the roof. Um, Aluminum, steel. It's going to be an industrial-driven commodity cycle, and so those things I think will be when people hear my talk about an 80% bear market in the bust, and then it not ever seeing these highs, or certainly not seeing these highs in the next couple decades again. They think that you can't have rallies. Yes, you can have a rally in the stock market, but you won't get close to, I think, the blow off highs that we'll see this year. And that gets people discouraged, thinking, well, this is the peak of all. I go, but there's plenty of opportunity because commodities are going to have opportunities like we've not had before. I mean, you're going to see moves there. It's just a different leadership. The leadership in this cycle that we're in now, the 2009 to 2023 cycle, it's been, yeah, I guess that's about right. You can look at 2020 as a separate thing, but that's all really one cycle from 2009. It's been driven by technology. It's been driven by growth stocks. It's been that winter, and it's been driven by other things. But basically, that's the leadership this cycle. Next cycle, those things will be laggards. They're going to face a lot of distribution, and instead, it will be commodities and industrial stocks that will lead the way. And commodities include oil, commodities include precious metals, commodities include base metals, commodities include agricultural foodstuffs. So that's an area that's going to be huge winners, and the things but what it does say is that this easy game that has been played for a long time of just putting your money in passive investments in index funds, that game's not going to do so well in the post-bust era because with higher inflation and higher interest rates, particularly higher interest rates, PE multiples, price earnings multiples, get compressed. They're an inverse relationship. So as rates move up into double digits and higher, PE multiples will be moving in the other direction. So if you're an index fund, basically a lot of an index fund's gains has been the multiple expansion. We went from 15 and 20% of rates back in 1982 to almost zero. That was the inverse of that was the PE multiples went from single digits up to the mid 20s as a market multiple. If you reverse that again and take that mid 20s multiple and head back towards single digits as rates move ever higher, it is tough to make money in growth stocks. It's tough to make money in it's tough to see index funds move anywhere because even the component that they have that is generating strong earnings, the commodity part of their index, is a smaller part of it early in the cycle. Because what are the highest weighted sectors in index funds right now? They're the things that have done so well. So technology in particular. If next cycle technology is the underperformer and commodities are the outperformer, your index funds, at least early on, are positioned opposite to that because it's all based on past performance. The short answer is index funds are not going to be the easy game they were this time. Now you can buy ETFs that are specific to commodities or what have you, but if you're thinking you can buy an S&P index and have the same easy game you've had for the last several decades, you're going to be surprised because it's going to be a tough place to perform.
Yeah, so definitely a shift perhaps back to active management, not as much passive.
Yeah, absolutely. I think that's going to be, and it doesn't happen early on because most people don't understand this. So early on, people are just going to be doing the same thing they've always done. But as they move along, it's going to become more evident that they need to shift out of passive funds or passive strategy and find areas that are outperforming and find portfolio managers that understand that, or portfolio managers that specialize in those areas that are doing well. Active management's been out of favor for a long time. I think it's going to be, they're going to have their day in the sun for at least a few years.
I know you used to have your day in the sun. Do you ever think of getting back into that, actively managing portfolios again?
No, I'm retired basically. So,
Yeah.
other than this, this keeps me in it. It's a hobby as well as a, profession. So I like to stay involved in it. But, my days as an institutional money manager are done.
Although you did have some great performance from what I hear when you were managing retirement or pension funds. But
yeah, there was a period. My favorite time to talk about is the early '80s. I got hired into Textron in late 1981, and it was right at the time when oil was peaking. Oil was having a big run. That was the big energy after the energy embargo in 73, 74, and then it ran through that decade. And energy was like tech has been, or what like tech was, at the height of this. You had all the big brokers had huge staffs of energy analysts, and their energy analysts were they'd find specialties looking for things that were tied to energy but weren't direct, to find new ideas and things. So there are helicopter companies that service the oil rigs. That was a hot play at one time, things like that. So it was like energy was the only game in town. I came in to Textron and we were starting a bear market, and I said, or had been in a bear market for a few months, and I said, keep your powder dry. I'll build a buy list, and we have time. And I held them off for about 8 months. And in August of 1982, I said, I think it's time. And this was a group that was very cautious about equities. They had been burnt in the 74 bear market. And so, the investment committee would say to me, G. William Miller, who had been the chairman back then and had since gone on to be Fed chairman, had been CEO at Textron, and he pretty much pulled all the money out of the New York banks, brought it in-house, and they did everything in-house in the second half of the 70s. And they were a top quartile performer. And then the oil market hit, and they didn't have much in equities. So it hurt their performance. They dropped down to the 50th percentile. And I came in because I said, hey, we can't be out of equities. We've got to be in equities, at least opportunistically when it's time. So they brought me in, not thinking it was going to be a big deal, just to have an added, equity influence. And I saw it as an opportunity. And I basically took them from 10% equities, and most of their equities when I went in there were almost private placements because that's what they were doing. So it was companies that were, could have been taken private because they were so unrecognized by the street. I went in and I took them from 10% to 50% equities, a top 1 percentile performance the whole 5 years. And our pension fund had doubled. So not only did it go up to 50%, but then was 50% of a much larger pie. So, and it was a lot of it was macro. I mean, it was recognizing the oil story is behind us. So I didn't have any oil equities, and recognizing that the inflation story was peaking, and that even though it wasn't going to go from high inflation to low inflation, it was beginning the trend, and that what you wanted to do was buy the things that were so hated in or did so poorly in inflation times, buy them at their bottoms, and they bottom when inflation peaks, and ride them for the gradual move in inflation. So I was buying Coke and Eli Lilly and lots of basically large cap growth stocks. And if you look at the history of the 1980s, it was the heyday for large cap growth stocks. And in 1982, when I was buying them, they were hated. I mean, they were, everybody was buying oil stocks and they were not buying that. So that's a classic contrarian story of, you buy when nobody else wants them, but you're looking forward, not backwards. You're realizing. Now, sometimes, I've been guilty of it in my cycles. Sometimes you're not that right on. Sometimes you're early, and it can be painful because the things that are working can go to extremes, and the things that aren't working can go the opposite extremes, and you look like an idiot. If you're a year early, and I did that in my not the next job. I went from Textron to Fidelity, but in my next job after that, I was doing the opposite of what I did in 1982 and saying, look, I was in the growth stocks. The consumer growth stocks are great, but they've gone up 20-fold from where I was buying them. And, there was a chart going around at that time that showed that consumer stocks relative to capital goods stocks were at all-time highs, and capital goods stocks were on their floor. Hadn't been there in 60 years, the relative valuations. So I was buying industrial stocks and tech stocks. I had half my portfolio or probably a third of my portfolio was semiconductor equipment stocks. They were flat on their back, and things like Texas Instruments, flat on its back, and I was buying those in 1991. Now, what the 90s were for tech. And so those things went up 20 and 30 fold. I wasn't there for the whole ride, but in 1991, consumer growth stocks had basically a parabolic blow off. So Coke doubled and doubled again or whatever. So, I looked like an idiot because I had index funds over in the firm I was in. I came in to build an active equity effort. And their index fund guys are going, look at him. He's lagging the index by 6 percentage points, 600 basis points. He doesn't know what he's doing. And they were jealous because they wanted the job I got. I got recruited in. And, he doesn't know what he's doing. And, but in the 2 years after that, between 90, well, it was probably 2.5 years, but by the time we got to 94 or 5, the S&P was up 50%. The S&P was up 2%, and my portfolio was up 50%. So it was 5,000 basis points. So yes, I lagged 600 basis points for a year, but the catch up was huge. So it just shows you how you got to have a longer term perspective, and you got to have staying power because they don't always go together. Sometimes people lose patience, say, no, institutional portfolio managers, no, you don't know what you're doing. See you. I think we are at a fairly important inflection point. I think the metals are, on the verge of a big, pretty historic move. That's both gold and silver. I think the commodity sector and the cyclical sector that's been consolidating for the last few months, they had a good January, but they really have been going down since. That looks like that's coming to an end. You mentioned semis. I still think semis will lead right into the top. So there's plenty of room still to go as big a move as they've had. There's a lot of areas that are really coming alive. Financials have obviously been hit hard, but even they will have a catch-up rally. The small caps have lagged for this whole move, certainly for the last several months. They're showing signs of coming out of their number. So I think you're going to see, which is typical in a bull market, the small caps start to catch up. And so I just caution people, there's a lot of bearishness out there. People can't see reasons to be optimistic. So at least in the next few months, that's where my optimism comes from. I often say, when people say, where do you, how do you derive your forecast? And I say, I look at technicals, I look at fundamentals, I look at my macro for sure. I look at sentiment for sure, but I also look at cross markets. And if cross markets can confirm what I'm seeing in my other analysis, it really helps. And the cross market right now is saying that we are, I think, going to see a melt up. We are, like I said, it's not immediate. You're going to rally and then melt up after that. But I think we're on the verge of a historic run, with metals being one of the big areas, I think. And then the other thing I'd say is on the other side, oil's, I've been probably the biggest bear on oil and got criticized when it ran up in the, because I turned bearish just before Ukraine got invaded and it ran to 130. But I've been bearish from 130 down and talking about, certainly once we get to 90 or 85, I've been talking about 60 or low 60s. And I think that's still the next target. With ultimately in the bust oil going down into the 30s. So, it's been an area of emphasis for most portfolio managers for the last year or two. Last year, I guess, year and a half. And I think it's probably one of the big underperformers in that time and soon to come. There's a lot more downside, I think, in the energy area to come. I think the defensive areas like utilities and staples are areas that probably will lag. Doesn't mean they can't go up, but they're going to lag, I think, in this final run to the top. It's really the cyclicals, still technology, financials will have to catch up. It's strange because it's a time when everybody's thinking they need to be defensive, and actually the markets, at least the things I'm seeing, are saying, no, you really want to be more offensive. So I just wanted to kind of get that in because we hadn't talked about it. But
Okay. Yeah, no worries. And then I know you also emphasize to people not, as to the best of their ability, not getting too euphoric at the top, not buying in to the S&P when it's at 6,000 as opposed to here.
yeah, that's a good point. I'm a forecaster. I'm a strategist. So what I do is forecast. Nothing I say is advice. You have to know yourself, and we're just understand where we are. We're in the last final piece of a 41-year bull market. So we may be in the last 3 or 4 months of that. So coming in now, after we've run from where we ran, the Dow was under 800 back I can't remember the S&P at that time, but the Dow was under 800 back in August of 1982 when this started. I think it was 782 or something like that. It's now 33,000 plus. So that tells you how far we've come. So yes, I'm forecasting a final move that's unbelievable, but it's also going to happen so fast and reverse so fast. You have to know your abilities and know your own risk tolerances and things. Do not get trapped in here. Don't view my forecast of a melt up as some easy money thing. It's not. Some people may be better off planning for the bear and the bust that's coming if they're not nimble. But most of all, you're right. What you have to guard against is at 6,000. I can almost promise you everybody's going to be compelled to be all in. You're going to have most of the street bullish. You're going to have reasons to be bullish. The stories out there that will accompany that run will be very positive, and it'll be easy to say, well, maybe you're wrong. This thing's going a lot farther. It's that time when everybody's bullish that you need to guard against becoming euphoric and guard against becoming, and for a lot of people, they'll probably fight this thing for another 1,000 points. And all of a sudden, the market's at 5,300 and they get bullish. And then, a month later, it's at 6,500 and about to roll over, and then next step down, maybe 6,500 to 4,000. So, you have to understand that we're in a game right now that's it's going to be high volatility. It's going to happen fast in both directions. So, don't just listen to somebody like me and say, well, he seems to be positive, I'm getting in, because we're in the treacherous part of the market. It's high. It may be high reward if you play it right, but it's also high risk. I think that's the important message. And saying equally, when we go through tough times in the global bust, and I'm calling for an 80% bear market from the peak, at the bottom, there'll be great opportunities because it's going to be very hard for most people to see it. At the bottom, in the bottom of the bust, things are going to look dire. And just understand there will be another cycle following this. You're going to have a lot of people talking gloom and doom at the bottom and saying there's no way out of this. We're down for years to come. There will be, because of central bank printing money, there will be another cycle. There'll be problems in that cycle too, but there will be another recovery cycle. So it's kind of just the bigger picture message.
Yeah, thank you for helping us to close out there, just giving people some cautionary, I think, just being aware of themselves if they're prone to give into emotion or getting caught up in the crowd. Definitely something to watch out for. I know that you do a quarterly letter by subscription. You're also very active on Twitter. Maybe you could let my audience know where they can find you if they want to hear more.
Sure. Yeah, I'm on Twitter most every day. So my handle is at Dave H. Contrarian. So not David, but Dave H. Contrarian. There are fake accounts out there, as most people with decent followings run into. They'll look like me. They'll have the same profile page with my picture, and a lot of my information and the handle, the username, Twitter username will be something similar to mine. It might be at Dave H. Contrarian with an M instead of N, or they'll change a letter here or there, whatever. You have to be diligent enough to check and make sure it's me. The easiest thing you can check is I've got 190,000 plus followers. Those people typically have under 1,000. So if you see it, many times under a few hundred. So if you see a profile that looks like me, just check the followers, and if it's that, you'll know it's a fake account. A lot of times they're tweeting out my stuff, or they'll tweet out a sarcastic tweet that sounds like me but is opposite to me or whatever. Um, just be aware. There are a lot of scam artists out there. Most of them are just nuisance. I don't know why they're there or why they get a kick out of doing it, but they do. And Twitter doesn't seem to care. They let them go. So that's that. And I do have a letter. As Logan said, you can contact me by direct message if you DM me on Twitter for details. It is by subscription, so there's a cost to it. It comes out quarterly, and I've been writing it since 2000. It's a macro based letter. It contains some of the stuff you see on Twitter, but I'm able in a letter to go into more in depth. And so it's not for everybody, but for those that are interested, just direct message me, and I'll be glad to provide details.
Okay, well, there you have it. David Hunter, thank you so much for coming again on the third time to the Contrarian. It's just been great to talk with you again and see your assessment of where we currently are in the market. So thank you.
Thank you, Logan, and enjoy your summer.
Thank you.